Hello everyone, welcome to Just Invest Today, and today we're talking about time in the market. Which one's more important, time in the market or trying to time the market? So this has been on my mind a lot since we know the market is overvalued, but I finished the book 100 to 1 and then I was rereading it over again, and this book is by Thomas Phelps. It's a really good book. I'm going to make another video on it, but in this video I just want to talk about the thing is that what is more important, because we know in this market everything is overvalued right now, but is that the most important thing, focusing on overvalued the economics of the market? I feel like in this book Thomas Phelps says you can make 100 to 1 even while you kind of bought stocks at their peak if you knew. But that's the thing, finding the company. We still, obviously, as value investors, you don't want to be paying over. We don't want to be paying for overvalued companies. But he talks about so many companies in the market that it didn't matter where you bought it. If this company was gonna compound for the next 20 years, it didn't it didn't matter too much. You could have bought it at a lot of these stocks at its kind of peak, guys, right? So that's got me thinking again, guys. So like, are we better investing in these companies that are kind of fairly valued, a little bit undervalued, or are we better waiting for these companies to get all the way down to our margin of safety price? And that's what it got me thinking, because there are so many times every single year, it doesn't matter, in the book, right? He goes through so many time periods: 1939, 1940, 41, 42, 43, 44. It didn't matter where the market was. You can always find a stock that's going to return 100 to 1. So actually finding the stock is way more important than actually buying exactly the right price, right? And looking for that huge margin of safety. Finding that company that's going to return 100 to 1 is far more valuable than actually staying out of the market and just waiting for that margin of safety price. So that's like something that you guys can think about and tell me what you think about that. But I'm going to read this article because this kind of like hints at what I was thinking about, right? So time, not timing, is what matters. Investors learning how to invest in the stock market might also ask when to invest. Knowing when to invest, however, isn't as important as how long you stay invested. So this article is basically talking about how long you stay in the market invested is more important than just kind of trying to knowing when to invest, right? So let's go into it. Trying to navigate the peaks and valleys of the market returns, investors seem to naturally want to jump in at the lows and cash out at the highs, but no one can predict when those will occur. Of course, we'd all like to avoid the declines. The anxiety that keeps investors on the sidelines may save them that pain, but it may ensure they'll miss the gains. Historically, each downturn has been followed by an eventual upswing. Although there is no guarantee that will always happen, trying to avoid risk could itself be risky, since it's impossible to know when to get back in. So that's the thing. Investors, everyone, we know the stocks are overvalued. A lot of people sold out, right? But no one knows when to get back in. Because what if that huge decline doesn't happen for another 4 to 5 years? We don't know, right? So you just, for those 4, 3, whatever years, you're gonna miss all those gains because you're waiting on that sideline, waiting for these huge opportunities. So guys, you gotta take that in mind, right? When you think about what we're doing in the market right now. So this chart below shows two hypothetical investments in the S&P 500 over a 20-year period ending December 31st, 2018. So guys, this study is 20 years. So this is a good sample size, right? So let's go into this article again. Each investor contributed $10,000 every year. That's very important. $10,000 every year. One investor somehow managed to pick the very best day. So one group picked the very best day, the market low of each year to invest. The average annual return on that investment would have been 9.16%. That's pretty good. The other investor was not so lucky and actually picked the worst day, the market high, each year. So one person picked the worst day to invest each year, and one person picked the best day to invest each year for 20 years in the S&P. Even with the worst investment timing, the average annual return would have been pretty much 7%. So guys, you invested in the market high every single year in the S&P for 20 years. You still would have earned 7% for 20 years. That's pretty solid if you invested on the worst day, the market high every year. At the end of the 20 years, the cumulative investment of 200,000 had a value of 415,000. So even selecting the worst day each year to invest, someone who continued investing in the market over that past 20 years would have come out ahead. It's important to note that the regular investing neither ensures a profit or protects against loss. However, the tables illustrate how regular investing can be beneficial. So guys, one person the person who entered the market on the best days, on the worst, on the lowest amount on the S&P, averaged pretty much 9%. The person who actually got into the market on the worst day, the market highs every single year of the S&P, still averaged 7%. So just think about that. Even in overvalued markets, you can still average a good amount if you're investing for a long time. And that's what we're going to get into, right? So guys, you can see on this side right here, remember 20 years, this is going through the tech crisis, this is going through the real estate crisis in 2008. So in 1999 the tech burst, and then in 2008, so recession. So two time periods where we can look where yes, the market declined huge. So you can see this guy 1999, 2000, 2001, these guys beating the market, kind of almost beating the market, beats the market 2002, 2003. He has 50,000 invested. He's made already 59,000. Look at this guy with the worst day investment. So he's this guy on the right side is investing in market highs. Look at this. It basically took him 6 years. So he's 60,000 already. 2004, 58,000. He's still not beating the market. It took him until 2005 to finally beat the market, 71,000, investing the market highs each single year. How many people do you think would have been able to be patient and continue to invest in the market even when they're losing money, basically? That's the key, guys. We're still, in the S&P, you're still investing even though the market's not in your favor, right? You gotta still continue to invest, even though you're not making that money, even though you're seeing market declines. So at the end of it, right, this guy averaged 7%, and this guy averaged 9%. So $200,000 invested all in total would have been 546,000 in the 2018 from 2009, and then in 2018, 200,000 would have been 415,000 from for that 20-year period. So look at what that does. That just shows you time in the market is more important than timing. The person who had the bad timing still got 7% compared to the person that got the perfect timing in the S&P and got 9%. So this has me just thinking, guys, we sometimes put too much emphasis on the market and what the market's doing. We might be better off just finding the good stocks in the market if we're investing for the long. This is all investing for the long term and just thinking about the long term. So this basically is talking about the hypotheticals didn't pull out the market, but instead of the course of 20 years, they had perseverance and they continued to invest in the market no matter what the market did. So this is and then this graph just shows you guys, the longer you have your money in the market, the better your odds are at actually coming out ahead. So, because we know in the short term, we don't know what the market's going to do. It can do anything. But in the long term, we're almost guaranteed to have more up years than down years in that 10-year periods. There's 77 positive periods in this 10 year, and then only 5 negative periods. In this 1 year period, look at this, there's only 66 positive and 25 negative periods. So you can just see the 1 year you don't know what can happen, but if you go to 10 years, the odds are on your side, right? So that's very key. And then look at this. the best and the worst of times. So, the past decade have been unsettling for many investors. The recession of 2008-2009 made some investors so fearful they stopped contributing to their accounts or even withdrew their money at market lows, thus locking in those losses. They may have thought sitting out for a while seemed like a good strategy, but trying to avoid the worst drops means also missing the opportunity for gains. So that's what people think. They think they can get out the market and they think that they can just time it at the very bottom. But what if that stock recovers and then you might be missing out on all those gains? And frequently investors get out too late to avoid the worst of the decline. The chart below shows what would have happened to a hypothetical investment of $1,000 in the S&P 500 in the decade of 2009 through 2018 if an investor had missed the best days of that period. So this is what this chart is going to show you. If you missed out on the best days of the period because you were trying to get out ahead of the time, right? Guys, and we know the market right now is overvalued. A lot of people have money on the sideline. A lot of people are scared. But guys, we don't know what the market's going to do, is what I'm basically saying. So if that 1,000 investment hadn't been touched through the full period, it would have grown to 2,775 with an average annual return of 10%, 10.75%. But missing the 30 of the best days, guys, this is from 2009 to 2018. Missing 30 of the best days in that period would have put the investor in a negative territory, losing 8.18% of the initial value. So guys, see how missing 30 days, your investment turns to 918, a hypothetical $1,000? But if you invested the whole period, you stuck through it thin and thin, no matter what the market did, $2,775 you would have had in the S&P through that period. So guys, that article just shows you everything, and this just kind of got me thinking, guys. So we know as value investors, we don't want to invest in overvalued companies, right? But we know, guess what? There's so many stocks in the market. We can look at China, USA, we can use Canada, Australia, New Zealand. There has to be opportunities somewhere. We know there's opportunities somewhere to find at least a fair value company or undervalued company, right? So finding the best companies and actually being in the market might be more important than actually getting out the market now, thinking we know that the market's overvalued, right? So we're getting out the market, thinking that everything's overvalued, and kind of like waiting for the crash. I feel like as an investors, we know the market's overvalued right now, so we're not working as hard. We're kind of waiting for that moment to occur to us that the market's gonna crash, and maybe actually finding the best companies is actually more important, guys. But still, this is not saying you pay for overvalued companies, right? This is not what I'm saying. I'm saying is that maybe being in the market can probably be more important because we can be losing out those gains and we don't know where the market's going to go. So don't think you can time the market, take your money out thinking that, oh, this market can't last forever. Guys, if you're still in really good companies, really solid companies, stay invested in those companies, right? Because we don't know what the market's going to do, right? So, but I know most people have their money on the sidelines because they can't find companies. They can't find good companies to invest in. But on the flip side, this is what has me going crazy right now. On the flip side, Charlie Munger says, how do you become rich? Basically, you have slack money. You have that money on the side waiting for that opportunity to get all these crazy stocks cheap, right? So how do you I can't remember where I read it, but it's like Charlie Munger's, how do I get rich in the market? You have all this money on the sideline when stuff goes south, and you're just bathing in all these stocks. You're just getting every single stock coming to you at margin of safety prices, and then boom, it shoots right back up. So man, this is what I'm thinking about. Which strategy is better, man? Like, I think maybe like half and half is probably the best strategy, but the most important thing to me is finding that best company to invest in. No matter what the market does, We know we have a strong company, anti-fragile. It'll succeed in any market. So that's it for the video, guys. Tell me what you think of what I said. How are you playing the market? How are you looking at it? Are you still trying to find these good fair value companies, or are you kind of waiting on the sideline because you know companies are overvalued and waiting for that opportunity to pounce at good companies? Tell me what you think. Guys, if you like this video, can you like it, subscribe to my channel, and get back to you next video. Peace.